Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. After that, we will take a brief tour through our core list of companies. The big question there, of course, is will Facebook earnings be enough to save the day for the marketplace? Currently slated to be opening on a gap up. We'll get into that in just a moment. And then, as always, at the very end of the video, I've got one additional trade idea to share with you today, short and sweet, so definitely stick around for that. Let's jump right into the S&P analysis with our sectors. Who was leading, who was losing, and where was the weight today? The XLK for the tech sector led the pack. It's also the heaviest weighted sector, up 1.48%. Down at the bottom of the barrel, we see the XLC for communications down 2.23%. Ever since the last Netflix earnings cycle and the big gap down there, we have seen relative weakness in the communications sector, but if Facebook can gap up, maybe it starts to shift the tone to the upside. We'll ultimately see. There is some concern based on the daily time frame chart structure. Anyways, in terms of heavier weighted sectors, we covered the heaviest of them all, XLK top of the pack, 1.48%. Then after that, we've got the XLF for financials, second heaviest weighted sector, pretty neutral on the day in terms of percentage points, only down 0.08%, but nonetheless, again, the structure of that daily chart is still fairly concerning. Then the XLV for healthcare, third heaviest weight that we're watching, down 0.22% on today's session. Let's quickly cycle through all of the structure charts here. Zooming in on the XLK, let's spend some time here because obviously this is the heaviest weighted sector. It's important to kind of understand the dynamic. We have seen the 100% retracement, right? That has happened. Generally speaking, you do get some sort of dead cat bounce. It's very rare that you see the 100% retracement and then you immediately continue on lower for, let's say, something like 5 or 10 more points of continuation. So nonetheless, two outcomes to watch for here in the XLK. I suppose there's many outcomes, but this is what we're watching for to remain bearish essentially in the XLK, which is obviously a big concern for the SPY itself. And the reason we're bearish, let's cover that first of all, is because of our inverted hammer that printed on today's session. Ultimately speaking, this was a look below and fail. Notice how on the Tuesday session, we close underneath this prior shelf of support. We pop back above that prior shelf of support, triggering the look below and fail. But notice what happened with today's wick, right? We actually take out the prior day's high. That's a bullish indication, but we can't hold any of that structure. We've essentially closed right back down on the level. So I'm sort of thinking to myself, wow, the bulls really can't get anything going. I'm sure a lot of shorts, late to the party down here would have potentially been stopping out of their short positions, taking out the prior day's high, but it didn't stick, right? There was no traction from the buyers. So that has me feeling fairly concerned. So those two outcomes I was discussing, any lower highs that are essentially underneath this area right here, we should move this level. Let's go ahead and remove that. The more relevant one, at least as of right now, is that 146 bottom end of balance from right around in here. Any lower highs that do something like this, that's a bearish outcome, right? You can clearly see we are on that trajectory for a lower high. If that happens, an equal low reattempt in short proximity of time, that's where it becomes more attractive for this level to break down and give us a little bit more meaningful follow through, right? So that's scenario number one. Scenario number two would look something very similar to like what we've seen in NVIDIA over the past couple of weeks, which is just sideways activity kind of right down here. If we can stack up 4, 5, 6, 7 days of balance that really just don't go anywhere, then obviously that builds out as a bear flag. We've consolidated enough through time. We don't need that lower high. It also sets up enough consolidation for more follow through to the downside. So those are the potential risks I'm seeing here in the XLK. And again, in terms of walking through the structure of today's daily close, I'm just not seeing anything impressive really from the buyers at and around this level right here. Now in the after hours session, because Facebook is, kind of tied to tech, obviously it's more in the communication sector, but it is tied to tech. You're seeing a little bit of that activity to the upside here, but it's not enough, at least as of right now, to result in any meaningful gap up for the tech sector. We'll see how we open up for tomorrow's session, but I just wouldn't, have a knee-jerk reaction and say, oh wow, this is a huge bullish development for the tech sector, right? So seeing this is a kind of a risky area still on the daily time frame. Anyways, continuing along, builders and materials, not the biggest deal here, really lightweight sector. It's falling back down into this consolidation area. This doesn't really strike me as worth spending too much time on. Really just a neutral thing for the marketplace, noting it's such a lightweight sector. Energy, worth spending some time on here just because it's more of that risk-off defensive sector. Failed breakout, right? That is a positive development if we're going to see a more meaningful bottom in the SPY itself. So the question is, can we remain in this range now and just kind of go sideways? That would be, again, a positive development in my estimation for the SPY itself. If it breaks down further, not the best indication. Obviously, some more cool off would be okay, but it's just, again, sideways is probably preferred here inside of energy. Industrials, very similar to our builders and materials, right? Just kind of going sideways in this range. Doesn't really strike me as a big deal, risk on or risk off. Just, such a lightweight sector. And so sideways here, we're not going to read into it. XLP for consumer staples, definitely something to look at here. Noting again, this falls more into the defensive category, risk off category. Notice the possibility, not guarantee, but possibility for a bit of a head and shoulders pattern that's starting to emerge here. Your neckline, roughly 78.25. If that breaks down, again, that's a more meaningful indication that your SPY can find a bit of a better bottom here. And the tech sector, those more aggressive risk on sectors, can really lead some sort of bottoming activity that we see there. So if this breaks down, positive development, but I wouldn't really want to see it just go in a straight line all the way back down to these lows at 72, right? If it breaks, fine, just let it kind of do something like this. That, again, would be more positive for the S&P 500 in my estimation, just not leading the charge so much anymore here in a defensive name. So that's what we've got there. XLY for consumer discretionary, not the staples this time around. The risk here is obviously that we're not at support yet. So this can continue to go lower if, let's say, Facebook just fades all day tomorrow and just continues to put downward pressure on the market as a whole. Well, obviously your XLY has room to fall essentially, right? Without any supports in the way. So that's your downside risk. The positive thing here is that Tesla, the second largest holding in the XLY sector, is actually sitting at a support trend line off of its lows. So if Tesla starts to catch a bit of a bounce, maybe this kind of holds up at its support trend line like this. The big question, of course, just in the larger perspective would be, okay, fine, but what happens on the back test of this level right here around 176? Because ultimately, we do have a lower low. So here's a low, lower low, lower low. If we bounce to here, fine, we still technically have a lower high, right? So it's not the best, bullish development here, noting the slight relative strength we have from that trend line perspective, but nonetheless, critical levels to watch. Back tests of 176 still strike me as bearish, noting the current and recent trend that's going on here, and continuation to the downside also strikes me as a risk. So really, just looking at the XLY is kind of in danger right now, regardless of whether or not it's higher or lower. The only positive thing would be, okay, if we do this and start to form a higher low, maybe that starts to shift the trend, but as of right now, just, that's complete speculation. Anyways, continuing along, XLF for financials. Again, this is where structure is starting to become continuously concerning, right? Obviously, just like we talked about in the XLY, clear opportunity for a lower high, even if this makes a bit of a dead cat bounce. We did make a lower low underneath this section right here, so the trend is not going to change to the upside quickly in the blink of an eye here. Notice also, again, inverted hammer closing underneath and weak. The buyers didn't really have anything going on here. Even if we do bounce, anything that kind of remains underneath this two-day high set in here just strikes me as bear flag consolidation for a perspective that looks like this, right? So kind of concerning here in the XLF. And if we scrunch out the chart, next support underneath, I guess we're kind of at it. Let's actually go a little bit further out here, grab some more time and see how much potential risk there is to the downside. Wow, look at this. Okay, so prior to this big area of consolidation, something that would look like this, the market was kind of on a little bit of a rally there. So 33, right, strikes me as the next big area that the financial sector could potentially go to. And that's, obviously just big continuation to the downside is a huge threat to your S&P 500. Now, I will sort of point out, yes, we have seen that 100% retracement round trip phenomenon. So I wouldn't just expect this to happen in the blink of an eye. But again, the structure here is what's concerning, again, which is why this is sort of deceiving, right? Always look a little bit further than just your percentage change on the day. So that's your XLF. While we're talking about financial things, let's quickly take a look at your TNX, which is the 10-year rate. And if we zoom in here, let's actually just flip this back down to a yearly chart. That way we're not loading so much data. The concern is that we have something that's starting to look like this again, right? So a bull flag here, roughly under that 3% mark. Remember that that's always a decimal here. Does it break out and continue? Obviously, that's more downward pressure on your XLK. I think the big thing that we all need to be aware of, this is not this week, but next week on Wednesday, we will have the Fed funds rate release. We are expecting that this time around, we will get a nasty double rate hike. So a 0.5 instead of a 0.25. That's kind of what I fear, or not fear, but I think the market is pricing in based on that fear of kind of uncertainty. Will it be the 0.5? Will it be the 0.25? That's what we're looking forward to once we kind of know what that is. I think going forward, the projections are that we'll fall back down to a 0.25 if the Fed can sort of be aggressive now and start to, really combat that inflation and kind of what's going on. Again, I'm not here to argue whether or not that's right or wrong. I think the idea is, okay, let's take the pain now in the short term for potentially an easier long term, right? And we can revert back to that 0.25 as soon as possible. So those are my thoughts in terms of rates. And again, this isn't helping out your financials anymore. It's really just putting more downward pressure on your XLK. Continuing along through our sectors, XLV for healthcare, it was the relative strength monster as it was making this move here. Again, structural concerns underneath the double bottom neckline from right here. Right? Inverted hammer on today's session underneath the two critical moving averages. If we do move lower, your look is for roughly 128.50s. Again, that's just big downward pressure for your S&P 500. Not the best look. Again, so I think the majority of things that we've looked at today are actually pointing to more risk right now at these lows instead of a clear or obvious turnaround, right? Utilities up next. This is so maybe in the opposite camp, right? This clear breakdown of the bull flag that we had up at the top is signaling that this, as a risk-off sort of sector, is actually not indicating a lot of interest or a lot of love right now. So as money flows out of a risk-off sector, maybe, just maybe, not a guarantee, it starts to flow into risk-on sectors like your XLK, maybe the XLC, which we'll get into in just a moment. So this also, just like the XLP, if that were to break down from its head and shoulders, would strike me as a positive development for finding a more meaningful bottom in our S&P 500. So continue to watch this go lower. Again, I think as long as we're not blasting right back up to all-time highs, good sign here in utilities. Real estate is going to have a similar look. Again, here is that consolidation. This is sort of, again, in the defensive class, falling back down, look above and fail. It's fulfilled the target. It's at the bottom end of the range, some cooling off, some sideways here. Welcome for a more meaningful bottom in the SPY. Then last but not least, the XLC for communications, completely taking a nosedive here. Again, this is why structure is so important. Even if Facebook reports fantastic earnings, we remain on the gap up tomorrow. Nothing changes here in terms of trend until we can clearly develop a higher low or start getting acceptance back above 64, which is quite a ways away, right? If we take a quick look at the 30-minute time frame with after hours on, sure, we are getting a meaningful gap up right now, but we're not at 64, right? So if we take a look at the daily time frame, anything that does this, right, that's just a lower high. Lower high, lower high. We've made a significant lower low underneath this area right here. Again, this strikes me as a bit of an anomaly. I think the big part of that is the gap down we saw from Netflix earnings. I think in a regular case where, we don't have an outside catalyst, you won't see this, right? Again, you usually get a dead cat bounce and then it breaks after some sort of reprieve. But this has just been straight lower. So meaningful lower low, even if it does get into 64, there's the opportunity for a lower high. The only thing that would change my sort of thought and opinion on the communications sector is if, sure, we make the move higher, if we pull back and form a higher low, that starts to have me shifting my bias just a little bit, not completely, but just a little bit for the potential for a reversal in communication. So again, I think the majority of things that we've learned from our sectors today is that there's still a lot of structural risk out there that the market continues its trend to the downside. Let's quickly sum it up here on our ratio charts. In the top four, these are our risk on sectors. You can see that things are trying to improve, but we're not there yet. So here in the XLK, there was this obvious look to the downside, now more sideways, slightly more positive development, rather just not showing continued signs of deterioration. XLV cooling off sideways. Again, here it was as relative strength. Now just kind of taking a little bit of a breather, still well above an upward sloping 50 SMA. XLY going sideways. Again, it's just not showing us that clear downward look, which is a good thing. And then the XLF actually trying to form some higher lows like this, but still nonetheless underneath a downward sloping 50 SMA. So these are starting to show signs of the possibility for improvement, but we're not quite there yet, which is, again, why I think there's still some risk in the SPY itself. Communications, obviously, just, again, falling off of a cliff there. Not even going to spend time on that ratio. But down in the bottom four, we have our risk-off sectors. Notice how they all continue to look just fine to the upside. So continuing to point higher in staples, energy kind of hanging out at the highs, real estate hanging out at the highs, and the same thing in utilities, even though that chart's starting to break down. Just in terms of relative strength basis, these charts still look good, which is still more of a risk-off indication for the marketplace, and these don't quite look good enough yet for more of a risk-on indication for the marketplace. So hopefully that wasn't too confusing. Hopefully that all made sense. While we're talking behind the scenes things, let's take a quick peek at our VIX for volatility. All I would point out here is that we're firmly off of that 2050 floor. We never broke back down underneath it as we spend more time above. Just remember that this makes it more difficult for participants in the marketplace to feel more comfortable about their positions. What it means for us as day traders is to continue to expect large amounts of volatility. Just as a quick example, I use this one all the time. If this is your normal entry, this is your normal target, and this is sort of your normal stop, hopefully that's roughly a 3 to 1-ish risk-reward ratio, your entry is going to remain the same. Your target should expand a little bit, and your stop should expand a little bit. Notice the ratio didn't change, but expect larger swings on your trades themselves as we get an elevated volatility environment. That's all there. Let's continue on over to our SPY itself and talk the nuts and bolts of the levels we should be paying attention to. I've got this 424.14. Let's remove that. I'll show you where that's coming from. But quickly, I do, of course, have to point out that, we are technically respecting these lows right here. And if the Facebook earnings do produce some sort of upward activity, then maybe this low remains secure from the invasion day around 410.65. Just a thought, but as of right now, again, just kind of consolidating in bear territory in my estimation underneath this level right here. There was no dead cat bounce. There was no back test of this. Bears still do seem in control, as we've pointed out through the sectors as well. The current outlook is probably going to be based on some shorter time frame indications here. That's where that level was coming from. What I want to do is walk you through where it came from. Specifically, here is this week's sessions, right? So we have Monday balance and a spike into the afternoon. If the market was going to remain bullish for a more meaningful backtest of the breakdown from the balance there, we should have remained above that spike, which was roughly that 424, 14, 15-ish area. If you like nice round numbers, just call it 424. Nonetheless, here's a spike. In the after hours session, notice that we accept in the spike, but as the regular trading hour session opens, it rejects those higher prices. So that to me is a bearish implication. We did not find satisfied buyers up here. Instead, we ran into sellers. Now, the opposite phenomenon happened into today's session, right? We have a spike from the afternoon of Tuesday. On today's session, we balanced inside of the spike almost the entire day, which is actually bearish acceptance instead of a bullish rejection, right? Bullish rejection would have looked like price acceptance above this sort of shelf around 422. Didn't happen. Notice that we roll over into the close. Obviously, again, Facebook earnings, a little bit of upward lift here, but nonetheless, I would not be bullish on this market until we can at least, at minimum, recapture that 424 to the upside and get back into that spike area right there. So those are my upside thoughts. To the downside, obviously, again, as we've pointed out on the XLK, really, some more sideways activity would be preferred before just looking for an all-out collapse. Obviously, if we do continue underneath the 2-day lows here, then we're just looking for the invasion panic day low as a first target at 410.65, and that would complete the 100% retracement officially back down to that area. Underneath there, just so I can prepare you, I'm not expecting that these levels will be in play tomorrow or into the remainder of the week, but obviously we have support coming in around 405 roughly as the next big structural element right here, and we do actually have a gap. If I go out to, let's just grab 2 years here to illustrate this to you, there is a gap, whereas it's closer to 400. Here it is. There is your gap, right? So underneath 403.27 roughly fills down towards $400.76. Just something to be mindful of. Again, I just bring that up so you're aware of it. I don't necessarily think we're going there into the remainder of the week. Again, a preferred look for this particular chart would be sideways consolidation for a bear flag, and then we break down, or some sort of dead cat bounce, and then from there, we would reevaluate on the equal low reattempt in short proximity of time. An interesting perspective that someone brought up today in the Discord, and we'll look at this on the QQQ because it's really more accurate there, but nonetheless, let's quickly go to a monthly time frame chart. Let's grab our Fibonacci's from the low of the sickness, go all the way up to the highs. We're not at the 38.2. The only reason I'm showing you this is because, again, in the QQQ, we will see something different, so use that as a sort of mental reference point. All right. So that's what we've got in our S&P 500. Hopefully that was enough to sort of illustrate the risks that are still ever present to the downside here. Doesn't strike me as a clear or obvious reversal that wants to happen to the upside. In terms of internals and what's been going on there, let me quickly flip over to that screen. If you're not familiar with what I'm about to discuss, you can watch a video in the top right-hand corner that describes what this is, how to set it up, and how it'll help you make better intraday trading decisions. Nonetheless, look at the serious outflow that we still had on the Tuesday session. Again, usually we're looking for 300 million, whether it's positive or negative. We did see that and some on the Tuesday session, which does still strike me as some serious selling. The next one would be on today's session, the more balanced session. Notice how we do have a positive sort of read there, but if you were watching intraday, our breaths themselves were all over the place, right? They were higher, they were in sync to the upside, they were in sync to the downside, they were divergent, and now they closed divergent. So overall, the market's kind of in a more balanced state instead of continuing to trend to the downside, right? And I do think that's because we are coming into into those lows. If we take a quick tour through our advanced decliners, again, things getting really nasty on the end of day Tuesday. This, as we spoke about in the weekly watch, this video is usually unsustainable underneath negative 2,000. If you ever see those types of reads, I wouldn't be piling in short the very next day. And again, today is a great example of why there was some reprieve, right? There was a little bit of balance, a little bit of chop as the market digested the selling that took place the prior day. Nonetheless, positive advanced decliners on today's session. Really more a neutral indication. It's not like we hung out all day up in trend zone. Obviously, the market just balanced anyways, not reading into it too much. Again, another neutral, indication is the cumulative tick on today's session, right? This is certainly not an overly bullish day. To me, it just strikes me as neutral, bear acceptance underneath that spike that we just discussed on the SPY intraday 30-minute time frame chart, right? So to me, bearish consolidation is well underway, and we'll ultimately have to see if we can reverse that back to the upside, or we just continue to go sideways, cool off for a little while longer, and then break down. Our market profile is up next. Again, I've got another video for you. If you're not familiar with this software, watch this. Top right-hand corner is going to describe some of the terms I am about to use. Here we go. So here you can clearly see the spike from the Tuesday session. That's the string of single prints down at the lows. Again, notice how we take it out in the overnight session right here, except back within. And today's session, we have overlapping value. Value is just this yellow shaded area. It's completely unchanged on today's session, which again is a bearish implication. We're getting bear consolidation instead of trying to stack value higher and start to make changes back in the upward direction. So regardless of what price did, value actually remained unchanged. So to me, a bearish indication. In terms of our high, I would say it's not quite a poor high because technically we do have a little bit of excess here, but this really isn't the look that you want to see, such a flat top at the top. You want to see more of a bell-shaped curve, right? Something that does this with an equal distribution. Like this low to me strikes me as much more healthy than this high that we have up here. So what do we do about that? Obviously this starts to turn into that inflection point, and this is going to roughly coincide, not perfectly, but roughly coincide with the that 424 level that we just discussed on the SPY intraday. Here's sort of that pseudo spike from the Monday session if we just look at that. So again, it's not single prints. I get it. It's not technically a spike for all of you market profile sort of traditionalists, but nonetheless, it carries very similar implications with the thin volume on the way up and really just an impulsive move into the close. So to me, this zone overall, and for all of you ES futures traders, it's roughly 42.50 to 42.60. If we can clear that to the upside, it starts to shift the tone back to being bullish, and it negates some of this bearish balance. But you can currently see, even with the Facebook earnings, we're still hanging out right where value is. It remains unchanged. This, to me, as I've pointed out a number of times now, just strikes me as bearish consolidation, bearish acceptance underneath the spike from the Monday session. Anyways, getting on over to the platform to round out the broad market, we've got the QQQs. Before we go any further, remember that mental snapshot of the fibs that I just showed you. Again, someone in the Discord brought this up. If we come from the lows of the sickness up to the highs, very interesting perspective. Maybe I would have seen this on the monthly as we come into the monthly bar closes on Friday, but nonetheless, hats off to the gentleman who pointed out in the Discord. We're sitting right at the 38.2, which I think is fairly interesting. From a monthly perspective, this would certainly be a bull flag as long as we hold up above that. And I think the market's maybe trying to come to terms with that low as being the 38.2. So nonetheless, interesting stuff, right? So carry that forward as another piece of support potentially at these lows here. So drilling down to the daily though, talking about levels and what we can expect here. Again, we have seen that 100% retracement. Very rare that you just continue on immediately for, again, another 10, 20 handles in your QQQ. So I would expect either some consolidation and balance or even a little bit of a dead cat bounce here, especially knowing that Facebook reporting earnings is bullish, right? So I wouldn't necessarily be all out bear on the open tomorrow, expecting it to go lower. If we take a look at the intraday, just to see if we can find any of those similar sort of looks to what we just discussed in the SPY itself, notice that your spike here is not as obvious, but your spike into the close here and highs are equal, dead equal on today's session. So going forward, a level I would carry forward, tongue twister today, nonetheless would be right here. Around 322.60, 322.50, lows of Monday, intraday highs where the bear flag happened, consolidation, of course, top of the spike, and then right here as well, today's high of day. So if we can clear that to the upside, again, maybe that starts to shift the tone and we do see the dead cat bounce. If we can't clear that, if we just remain hanging out in here, to me, again, I wouldn't pile in short per se. I would look for the bearish consolidation that cools off sideways through time, sets up a bear flag, and then can continue on its merry way here to the downside in the QQQ. If we do do break out up and over that level, that 322.60 we just saw intraday, nothing incredibly bullish happens from the large scheme of things until we reach 335 and potentially break it to the upside. Remember that in a downtrend, lower highs could happen here on the back test of the larger breakdown point from this balance right here. So 335 still critical to the upside. To the downside, again, a look like this for a couple of days of consolidation. Maybe we balance Thursday and Friday, and then, you know, maybe in early next week, there's sort of a catalyst. We're sort of the expectation that we get that 0.5 Fed funds hike. That's where the breakdown comes from. What is support going to be underneath us? We are kind of at this level. Yep. So let's actually go out and grab a couple more years, search for a support together. We'll round out the broad market with IWM. Then we'll continue on our merry way. Next support is really around 308, right? Oops. So we don't want that. We want a regular level. Here we go, 308 coming from this sort of area in here. So support, right? Boom, first higher low, then it's off to the races. You get the gist. 308 is roughly the next area here in the QQQ. We would probably have to be a little bit more specific, looking for major turnarounds, like is it the actual level or not? But nonetheless, that's just a zone I would start to pay attention to if we see continued downside. So does look bearish. We talked about upside levels where a breakout could come from. If we remain below, again, bear flag consolidation is probably your outcome here. Let's continue along, wrap it up. IWM Russell 2000 and the small caps. Again, this is actually fairly useful to keep it on a larger time frame. We'll search for a downside target in just a moment, but nonetheless, we're at the low end of balance. We have seen that 100% retracement sort of look. It's not the cleanest one. Notice that a lot of the other charts have a clear up and a clear down without any of this sort of intermediate, I don't want to say nonsense, but structure perhaps going on there. So because this does have the structure, maybe it does have the opportunity for easier time just breaking down. It's not seen as a clear 100% round trip, whereas some of our other ones are. Nonetheless, 188 is the level here in IWM. Again, just like everything we've discussed so far, inverted hammer on today's session strikes me as bearish, lack of follow through from the buyers. Could this turn into a look below and fail? Maybe. Is this getting any love from the Facebook earnings? Not really. Kind of opening right on the level. So in IWM, again, I personally just continue to use this as a sort of risk on, risk off monitoring device for the market. Sitting at the low end of balance strikes me as a big risk off signal. Obviously, the breakdown here would be an even bigger confirmation that that is certainly going to be the case. And if we just scrunch up the chart a little bit here and find that next shelf underneath us, I would say it's going to be here around 180, 181 roughly, coming from prior support. If I just zoom in quickly there, you can see break, retest, and then it's off to the races. 180.75 would be your next downside target. So about 8 points, 7 points to fall to the downside. Certainly opens up the possibility that the SPY can continue if that's the case here in IWM. So overall, I do think even with Facebook gapping up, I think we've seen plenty of evidence here that still points to a significant amount of downside risk out there in our marketplace. Enough of that. Let's get into our core list of companies. We'll drop it back down to a daily time frame chart. Apple is obviously reporting earnings after the bell tomorrow. So this is something to watch, probably just exactly that, watch and not necessarily trade on tomorrow's session unless there's a very obvious setup. We're underneath the daily 200 SMA, same sort of idea with the upper wick that failed at the highs. Basically, not seeing anything impressive from the buyers. Anything going on from the Facebook earnings, opening closer to the highs. Again, I imagine that Facebook acts as a rising tide that lifts all boats, so to speak. Again, correct me in the comments if that's the wrong way to use that analogy, but nonetheless, I like it. I would be more patient up here at the highs. Doesn't strike me as an obvious long setup, and especially with earnings around the corner, Apple is probably hands off into the remainder of the week. You know, if you think you can nail the direction, that's fine, but I do think IV, implied volatility, theta, it might catch up with you even if you do get that direction correct. So anyways, I'm hands off on Apple. I ultimately want to see, do we find support down here at 152? If so, maybe there's a trade to be had there, or do we come back up and do we retest this level right here around 163.50? Currently right around that 200 SMA. Hands off. I've said it enough. Anyways, continuing along, Netflix strikes me as dead money still, probably going to be replaced by Google after the stock splits, and we'll see how the options volume sort of reacts. Anyways, we flushed the 3-day lows of the balance that happened prior to the open of this week. We're dead on the lows here. Just looking for continued downside. There's nothing really about this that would indicate any sort of support coming in based on where we're at. Facebook earnings, very little impact here on Netflix. Again, this is sort of a hands-off. I would not be fishing for bottoms inside of Netflix. Will likely be replacing that. Tesla, this is what we were discussing in the XLY, sitting right on the support trend line. In the weekly watch this video, remember that we were mentioning we would potentially look for reversals off of 945 or the support trend line area. Well, we're currently there. The look of this chart, though, is not to be looking for reversals. I mean, we have a solid red-bodied bar closing weak on the lows and an inverted hammer on today's session, closing again relatively weak for two equal daily lows. Just because we're at the level does not mean that it's an automatic buy. Context is always so key. So I would not be looking for reversals quite yet inside of Tesla. If we come back up and take out today's high on a big green bar, something that does this, maybe that shifts the tone. And then from there, I would certainly be willing to take bullish intraday setups that come for a back test of 978.50, right? So that would be how I would play this. But currently, that's not what we have. So as of right now, the 2-day lows are actually turning into a flush point. Can we get continuation underneath that for something that comes into that 800 level? Let's quickly see if anything's going on here with the Facebook earnings. Not really, just kind of neutral in here. So overall, I would say Tesla, probably look for lower first based on the implications of the structural candles that we have in front of us, and only look for longs if we can maybe on Thursday get a green bar that closes green above today's high for the back test of the flush point in here, 978.50. Enough on Tesla. Let's continue along. AMD, what do we see here? Continued weakness, but it's very tradable, right? Notice how we have breaks, retests going on all the time here. AMD has printed an inverted hammer. Again, it's closed weak underneath the prior day's lows. There was no sort of acceptance from the buyers in the prior day's range. If we quickly flip to the 30-minute intraday, again, pop was sold, right? So nothing about this strikes me as overly confident for reversals. For a better long, I would want to see a proved higher low above that 92.50. For continued shorts, just look for your breakdown of 85, right? Earnings are around the corner. They're not this week, so there's plenty of time to be trading AMD into Friday and even early next week, right? When our earnings there, 5.3, right? So I believe that is the Tuesday session. Next up, we have Facebook. Obviously, this is the big one to talk about. Let's quickly just, let's do it on the 30-minute intraday after hours chart here. Big gap up, very likely for tomorrow's session. As we saw, it doesn't really have the biggest impact on the remainder of the market, but nonetheless, in this isolated incident, we can apply gap rules and we can look for, early morning trade here for inventory correction. So we do have a gap higher, which means, again, gap rules will be in play. So you want to know your overnight high, you want to know your opening print, and you want to know the prior day's high. So if we fail to take out or find new buyers above the overnight high and we trade lower through the opening print, that technically triggers a short trade to correct the inventory and start to fill the gap underneath. Now, do I think we're going to come from, like 205 roughly down to 180? Probably not. I don't think that the market wants to fade the entire gap in one sitting just because it's so large here, but I would look for some selling pressure if we fail at the overnight high. On the daily time frame, so let's just remember we're opening close to 210, that level we have mapped out. Remember, let's zoom in a little bit more so that gap isn't skewing things. Here we go. Even if we retest that, it could potentially be a big lower high, right? Something that does this is still technically a lower high. So watch to see, can Facebook open here? And if it does and starts to fade, bearish signal for your marketplace. Very obvious, right? If it opens here and just goes sideways, maybe, just maybe, that starts to shift the tone, right? So if we get sideways digestion up here and can poke above these levels, maybe that's enough to shift the tone in the XLC, bring in some more money there, more of a risk on indication, but it's pure speculation as of right now based on this gap. I do think that people were probably overly short down here, just sort of anticipating that we would get something similar to Netflix. So I would imagine that there's a fair bit of pain tomorrow morning on the Facebook open, but nonetheless, use the framework. How do we act at the overnight high? If we trade lower through the open, look for the short to start to fill some of the gap. I wouldn't be overly aggressive and look for it to all fill in one instance, but certainly lower could be the look on that particular setup. If we consolidate and go sideways, I wouldn't chase it long on the gap up. Instead, I would wait to see if we can build out some bullish structure before flipping back to being bullish on Facebook overall. NVIDIA up next. Let's cruise along here. I know I'm spending some time, but nonetheless, on NVIDIA, Currently lower, oops, let's get that drawing tool. Lower breakdown of balance, right? This is that round trip balancing phenomenon. So no lower high or obvious bounce was produced at the trend line, right? So this is what we can look for as similar in the SPY and the Qs, if that's how it wants to pan out in the first place. But nonetheless, getting that follow through to the downside, inverted hammer on today's session, closing underneath that 190. Remember, guys, that there's still some room to fall, some serious room to fall into 155.50 here inside of NVIDIA. With the Facebook earnings gap up, we're kind of still neutral in the range, not an overly big concern there. I would look for continued downside pressure underneath yesterday's low, especially if Facebook is fading off. Obvious setup that there's weakness across the marketplace, taking shorts into this large range underneath. We have seen the failed backtest now, or maybe it's a successful backtest, depending on how you look at that. But the buyers didn't get anything going. We actually closed relatively weak compared to everything else that we've seen so far. Next up, Microsoft. What do we see in Softy? Current look, inverted hammer on today's session. Small green body, I'll give it that. Did technically close green, but nonetheless, again, no confidence here from the buyers. We were up here at the highs, faded all of it off, right? So that strikes me as fairly concerning. Anything from the Facebook? Not really. So next long trade is still for this gap to fill overhead or recapture the 50 SMA. That's what I would watch for there, now that we have this choppy structure through the prior balance there. And then the next short trade is underneath today's low to get back down to the lows in here. And that, to me, starts to set up a larger downside trade in Facebook. So here's your 100% retracement. There's your dead cat bounce. If we can equal low reattempt here in short proximity of time, again, that's the more attractive breakdown underneath that 271.50. So keep that in mind here inside of Microsoft. Last but not least, we've got Amazon the Beast, and this, there you go, 100% retracement. Would expect some sort of dead cat bounce. Earnings are around the corner, probably hands off into the remainder of the week. You're getting a little bit of a lower wick on today's bar at the lows. So again, if you do see a pop, if you're dead set on trading this tomorrow, maybe it's a long up and over today's high for a little bit of follow through here. I wouldn't overstay your welcome and hold that through earnings, especially if you're trading weeklies. And then your short is, okay, can we put in a lower high equal low reattempt? Exactly what we just saw in Microsoft for the better short trade underneath 2,700 roughly earnings. Again, could completely throw a wrench in that analysis that we've just done. So that is our core list of companies. Now let's get into the single trade idea I've got for you. It's in the financial space. Can you guess it? It's SCHW for Schwab, Charles Schwab, that is. And why am I bringing this up? Again, it's a very easy trade here. 3 perfectly equal lows at 68.50. If that level breaks down, we are looking left and we are looking for a day trade into 67.33, the low from right around in here, and make pretend and extend to the left with me, the low of this sort of balance and chop in there. That's a quick day trade. Could you hold it longer? Maybe. Make sure if you do that, go out in expiration. Don't trade weeklies, obviously. I would not hold that through Thursday into Friday. Right, we've obviously been lower significantly. We are getting some balance here. 3-day lows are just so perfectly equal that I had to bring it up as a flush point for an intraday scalp to that 67.33. So that's it. Just one trade idea. Other than that, the market kind of looks shaky, right? No obvious trade setups out there. If there were, I obviously would have brought them to today's video. So maybe that in and of itself is kind of an indication for where and how the market's actually poised right now. So nonetheless, if you enjoyed today's video or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget that the weekly watch list video will be coming out on Sunday as scheduled. And with all of that being said, I wish you all a green trading week.